This is your Wall Street wake-up call. Oil prices are in focus following OPEC's agreement this week to cut production, but investors remain skeptical. I'm joined now by David Lebovitz, the global market strategist at JPMorgan Asset Management. And David, it's great to see you. There are now reports that Iraq doesn't believe or doesn't trust the OPEC production numbers that it uses. And of course, the details from this agreement, shall we say, won't be released until OPEC's November meeting. So what's going on here? Do you buy sort of the validity of this agreement?
So I think that what's clear is that very low oil prices were hurting economies other than Saudi Arabia. The other members of OPEC were very frustrated that Saudi was pumping, and our view has been an agreement would be reached at some point in time. Now, you made the point that we won't really know the details until the November meeting. Obviously, a lot can happen between now and then. So, I think the way to think about this for investors is it probably puts a floor under the price of oil, but it doesn't necessarily, push it up through the ceiling. So we expect more stability in the price of the commodity, but again, we're not necessarily sure that it's off to the races.
Well, and on that note, I was going to ask you, does, deal or no deal, does oil stay between $45 and $50 a barrel for the rest of the year at least?
I think it does. I think the low could be closer to 40 as opposed to 45. I think when volatility picks up, when people get nervous about emerging markets, we've seen oil move down towards the lower end of that $40 to $50 range, but it feels like we have found a range, and that's certainly an improvement from where we've been over the past few years. So we expect oil prices to be relatively stable through the end of the year and then gradually appreciate throughout 2017 and 2018.
Because let's remind people, the proposed production cuts are less than a million barrels a day, which is, not doing much, right? That's not a big enough number to really impact prices.
Exactly. It doesn't really move the needle, and you're also hearing reports that certain countries that are just bringing their oil production back online want to be exempt from this production cut. So the question to my mind is really, what does this mean for the big oil producers? What does it mean for Saudi Arabia? And does it have an impact on the way that oil producers here in the U.S. Then behave? The issue this entire time has really been too much supply. A lot of that supply came from the shale, it came from the frackers, and so if we get U.S. oil producers behaving a bit differently, I think that's what's really going to make the difference when it comes to the price of the commodity.
Now, we know the stock market is, of course, obsessed with oil, but right now the markets seem more concerned about European banks like Deutsche Bank, which obviously is facing a behemoth fine from the Justice Department and perhaps has some capital issues. What's your take on what we're seeing with European banks?
What I would say broadly is this does not look like a 2008. European banks are far better capitalized. The regulatory structure that is in place is far stronger than what was the case in 2008 and 2009. So our view is that, is there a risk? Absolutely. European equity indices will remain under pressure because 20% of the index is financials. But this doesn't really seem to be the beginning of a systemic crisis. Again, it seems to be relatively isolated to a few players in the European financial market.
All right, David, we'll leave it there. David Lebovitz from JPMorgan Asset Management. David, thanks for joining us.
Thanks for having me.
I'm Scott Gamm, and you're watching The Street.